Multifamily investors, you're not going to be able to make some intelligent investing decisions if you don't have the best information. That's what we're doing right here on the Gray Report. We've got new research reports giving us a sense of where the multifamily market is today and where it's going to be going over the next couple of years. You want to tune in, make sure you subscribe to the Gray Capital YouTube channel today on the Gray Report. An incredible slate of new multifamily intelligence from The Atlantic, looking at a piece, go over the labyrinth of rules that created the housing crisis. And then from CoreLogic, 10 things to know about the mortgage and housing market right now. And then moving to the Harvard Joint Center for Housing Studies, rental markets are cooling, but rents are still exceed pre-pandemic levels. And then from RealPage, major themes in second quarter earning calls from multifamily REITs. Again, if you're a multifamily investor, active or passive, you're in the right spot. We're going to be breaking down all these research reports and more. Again, every week on the Gray Report, we're covering what's happening in the multifamily industry, commercial real estate, and the macroeconomy. I'm joined again by Dr. Matt Bosnagel, Director of Communications and Marketing, producer of the Gray Report. Let's get into it. Welcome back to the Gray Report. Thank you for joining us once again. We do the Gray Report every single week to break down what's going on in the multifamily industry. Matt, it's going to be a busy week. Economic data, we've got ISM surveys, we've got jobs reports.
Jobs.
All it's going to affect interest rates, right?
Why did the stock market crash a couple days ago? It's almost like they maybe got a preview of the jobs report. Who knows?
This week, well, and you know what happened last time? In August, big pullback. Could the same thing happen? Maybe not.
No, jeez.
While that's important and certainly affects the broader economy and even the multifamily industry, we're going to be looking, more.
We got bigger fish to fry.
We got bigger fish to fry than some of those surveys.
Yeah.
Okay, this piece again, it's less transient and impactful today, but this piece from The Atlantic. I want to talk about, man. I want to know why you thought it was important. I think it's important too. The labyrinth of rules that created a housing crisis.
So a couple of weeks ago, we discussed that Atlantic article arguing about, algorithmic price fixing. And this one really highlights the issues of supply and regulation specifically. All the obstacles that someone might encounter, that many people are encountering when they want to build either an accessory dwelling unit, which is just maybe it's a little building on your lawn that has that someone else can live in. If you're increasing the housing supply, you're going to get a lot of local opposition, and that scales up to maybe you want to build an apartment. Well, no, the neighborhood's going to have their say against it, and increasingly, it seems like a smaller number of people are exercising their power over a larger number of people that are actually in need of homes. At the risk of repeating myself, I did want to note. So last weekend, 2 weeks ago, we talked about an Atlantic piece. It was more about the restrictive side, the potential that we may see some scrutiny over the apartment market, particularly on what they call as algorithmic price fixing. Rent growth has been at near zero for the past year. And that's just a careful reminder that if these algorithms were fixing prices, why haven't they fixed them to be above zero? And in some cases, negative throughout the country right now.
So you're saying housing crisis, it's probably not because of this algorithm boogeyman that's out there that seems scary. It's much more related to policy and zoning, and which comes down to a lot of local decisions. And it's the idea that, a decentralized system of where zoning decisions are made at the, the hyper local level, but they can still be an impediment against, an individual's desire to improve their own property. So it kind of comes back to property rights, but also kind of we live in a community, and can someone just build a an 80-foot tall watchtower skyscraper,
and the effects of that
on their backyard,
and the effects of this a kind of overregulation is to make housing prices much more much more expensive. Housing has also in another argument, I would say that would kind of defend against this idea of price fixing. Housing prices, the prices for single family homes have increased at a far greater rate than rentals. And even though interest rates were very high and kind of suppressing apartment demand and suppressing that price growth for single family homes, those single family home prices have increased far more than rental prices. There's no algorithm that they've cited yet for single family homes.
Well, remember Zillow? Remember in the pandemic,
maybe that's
Zillow?
The algorithm now. The next one.
When they did the AI buying.
Yeah. It didn't work for them, did it?
It was horrible. They ended up losing a ton of money, for the AI iBuyer.
So back to these
scheme.
Labyrinthian rules. Now, those are so much more of it's easier for me to understand. Like, you can put a boogeyman out there. It's going to be in a lot of places. You were showing me right before the show today, someone who was talking about how the meat industry is controlled by very similar algorithms, and
everyone looking at the same statistics
we
and
said
numbers. And
2 weeks ago, they're everywhere.
Well, and again, the question is it collusion, or is the amount of information and data allowing for more like efficient decisions? And some of those decisions may be similar because everyone has the same information. But
I'll be honest, it probably does help improve rent price. It probably does contribute a little bit to rent growth. Otherwise, landlords wouldn't use it. But it's hard to view them as a real market dominant force while actually acknowledging the lackluster apartment performance in this past year.
But is it pushing price? I guess here's the bottom line: is it pushing prices above where they should be, or is it pushing prices to where they should be? And the alternative is artificially lower rents than market would actually bear.
And I think that's exactly. I don't.
Now you could say, should we squeeze everybody to the max of what the market could bear? But I think you could say that again with many other goods and services as well. Yeah. And kind of the point of capitalism is that you're trying to charge a maximum price that the market is willing to bear and someone's willing to.
As long as that encourages apartment supply, which I would argue that it largely has. The high rents led people to build more apartments.
Exactly.
Then that's great. If you're in a constrained situation where someone owns the majority of the apartments and they're using an algorithm and they're and you can't build anymore, then we may have an argument. So there may be select areas in that this idea of price fixing or collusion or monopolism or antitrust works. But by and large, 99%, it's not. There's already competition and there's already market forces in terms of the ability to build new supply. So that's
so what you're saying, and I know we're talking about, and this Atlantic piece is more of a jumping off point about the housing crisis, and I think it actually focuses on some of the challenges again. And the solution is new supply.
Yeah,
some of the zoning restrictions or just overly. It comes the idea of NIMBYs, not in my backyard, and overly passionate. It just takes the efforts of a very few, as in
maybe
like one person, to bring up concerns, whether that's at that city council or zoning meeting, to say, hey, what about the article talks about, hey, what about the parking? They describe a fiction story of, like a father that wants to build an ADU, accessory dwelling unit, for his father to live with them to help raise his kids. And he's got all the plans. He's doing everything by the book. But still, the city council is like, hey, how about parking? Do you have enough parking? He's like, my dad doesn't drive a car. He's going to borrow my car. And we've got a garage in a driveway. And they're like, well, when are you going to rent it out? He's like, no plans to. But well, what if you did rent it out? And is it going to cast a shadow on your neighbor?
Yeah.
And then the guy down the street who just doesn't like any of the new construction in the area, thinks it all should stay the same, just opposes it out of spite because he doesn't want any new buildings to go up. And then, if he gets approval, then you can still be sued for, environmental impact and a variety of reasons. Now, sometimes it goes smooth and it's okay, but it exemplifies some of the challenges. And again, all of the data, all the science points towards the way for a more healthy housing market, better levels, levels that folks can afford is through new supply. Yeah. And we've seen out in California, which has, probably some of the worst part of the housing crisis in the country, they've really latched on to this idea of ADUs, especially in like San Francisco and LA and San Diego, because they're having a hard time, building a whole apartment community. Yeah. And some of these areas that are in California, the issue is because they never densified the way that they should have in the areas that they should have. So it's all, lower density, single family homes. Like, how do we increase this density? Well, the NIMBYs still aren't going to let us build an apartment building, but at least allow us to build these little cottages in the back so we can at least, increase supply by at least maybe, 10, 15, 30%.
Yeah. It is interesting. There's a powerful quote here. I think that it explains how it's actually not just the angry neighbor NIMBY. They're the ones that that make for the great story. And I do think it is a good story about how, this angry neighbor at all levels, can make something cost $20,000 in order to kind of meet his demands, or
and then all of a sudden you can't afford to do the project.
But ultimately it is the law and the structure of regulations that empower these people. And it says, Jerusalem Demsas, who's actually a really great housing expert here, she writes, NIMBYs win because land politics is insulated from democratic accountability. As a result, widespread dissatisfaction with the housing crisis struggles to translate into meaningful change. Instead of relying on discretionary processes subject to review by countless actors, governmental bodies, and laws, states should strip away veto points and unnecessary local interference. There's this structure where it gives a handhold to the opposition at every single point. And at a certain point, I hate to say it, but you don't matter as much as the 50 people that want to live somewhere.
Yeah.
And the rights
of the person who owns the property. I mean, at some point, again, I understand you live in a community that has rules, zoning laws, but it's like at some point, if it's not going to adversely affect someone, it's not going to harm somebody. Mm-hmm. It's not going to damage the value or reduce the value of someone else's property. What's the standing to not let somebody do it? Again, there should be some checks. I think that some boxes to check. Again, if you're living in a community and you're all agreeing to some rules, I think that's fine. But obviously, I think we could use a little bit of correction.
And I do think, as much as the author here notes that this is a long problem that doesn't get enough attention on the national level because it's a lot of these disparate discussions and conflicts, one neighbor's cul-de-sac and the other neighbor's, street, but they don't have this kind of unifying idea. Well, I think that that's kind of emerging now with the high housing prices and the high housing demand, and everything's so pent up that maybe we could see some movement here. I'm crossing my fingers.
I think that the idea of the NIMBY is much more in kind of the zeitgeist and conversation than it was a decade ago. Even a couple of years ago, but people say, what is a NIMBY? Mm-hmm. And they weren't really thinking about it in that context. I'm hoping, with conversations that like we have every single week and similar conversations and the focus on the housing crisis and the realization that, again, rent control is not going to be the solution. We need to build more. This becomes more of an active conversation of like, hey, instead of focusing on symptoms to the problem and putting little Band-Aids, let's get down to the core of the issue. How do we unlock more supply? But it has to be at a local level across the board. It's not going to be a national zoning regime, even though they're like maybe if some sort of maybe a bill of rights for landowners or property owners. But again, I think we still appreciate local control over the places that we live and the communities, and so it needs to be kind of a ground up. And
that's what I think is made it so difficult. Is there is this thing in America, right? Man's home is his castle. There we try to kind of default to local government and local determination, but there are some things that are bigger than the neighborhood, and and we have to acknowledge that.
Well, it's Republicans like local control, local government, maybe Democrats too, maybe like more of federal centralized systems. But then the local government can infringe on the individual.
That's exactly it. I was just going to say that
you need the federal government to protect the rights of the individual.
So it's how you frame it. Exactly. Yeah. So at the very basic, even the example that she uses here, it's the rights of an individual are being infringed upon by the rights of the larger government, whether it's the neighborhood, the HOA or whatever.
And the local government can sometimes be the most authoritarian. Also,
true.
Because everybody's buddies, and no one wants to ruffle the feathers, and you got one strong man city councilor, and everyone's like, well, I don't want to get in Jim's way. Bob's.
I've seen that a lot of times. Sometimes they're not always named Jim.
No, I didn't mean to use name it for dad.
That's fine.
That's fine. I wasn't. Okay, so CoreLogic has a piece, Matt. 10 things to know about the mortgage and housing market right now, as of August 2020.
So I wanted to stick with the single-family home topic here. Just a little update on what the single-family home market is doing. The story has been low home sales, but still high home prices, and that's about the same. I'm not going to cover all 10 here, but I just wanted to review.
What are some of the highlights?
Market's still characterized by high mortgage rates. This environment is not going to fade away anytime soon. And it's not going to fade away the instant the Federal Reserve starts lowering interest rates. I'd like to think that maybe there's going to be a psychological effect, but I'm not going to count on it. I don't think the home buyers are watching the Federal Reserve as much as like stock traders are, so
but I don't think they're watching the Fed, but I think that people think a lot about interest rates more. The general public's thinking about interest rates more than they did over the last couple decades, just because it went from like they've heard friends who locked in 2% interest rates, and like that sounds great, and they know the reason why they can't buy houses is because of interest rates. And so for that, and then they've been told by a real estate agent, well, wait until rates come down. So I think again, I think it's more conscious of it.
Totally. Then I'll skip to the last one before I get into the first one here. Nearly all borrowers, 92%, currently hold a mortgage with a rate below 6.5%. There's your lock-in effect right there. But back to first-time home
6.5%. I mean, some people,
that's still pretty high. So that's
high,
but the market,
but still, the weighted average outstanding mortgage rate is 3.93.
Okay. Well,
which is the highest in 4 years, but that's still in today's world, that seems pretty good.
Yeah. So the select few, like I think we've said before, it's the people that have to buy are still buying. It's just relatively few. First-time home buyers, particularly, are still elevated compared to 2022, which reflects this lock-in effect that we're talking about of existing homeowners not wanting to sell their home and buy a new one with a higher interest rate.
That's probably some demographics also. There's just like more of the cohort that would be a first-time home buyer.
Yeah, I think that could be it too. And I don't know exactly the dynamics of what happened with the lower interest rate, because it seems like in 2021 in July, the first-time home buyers were at 38%, and interest rates were quite low then. So there is some volatility here that is unexplainable by interest rates alone.
I mean, bottoming out in July 22 makes sense.
Yeah,
that's just that
because that's when rates really.
But it's all within a pretty tight band. I mean, we're basically just talking 34% to 40%, and we're kind of at the mean, and really, again, I think it's the
we're above pre-pandemic. It looks like
exactly. We're above pre-pandemic, and I think again, this is demographic driven. This is just a large cohort of 30-somethings who are looking to buy their first home, and even though that less of them can afford to, there's just enough of them to maintain this level.
And so Another development here is, so loan to value decreased 2 basis points to be 89% for first-time home buyers and 79% for repeat buyers. In contrast, the average debt-to-income ratios have steadily increased over the last few years due to the unprecedented surge in home prices. I think mortgage payments and debt are getting tough, and it's not difficult to see higher interest rates as a factor in debt-to-income ratios alongside the increase in home prices. Also, the median list home price and median sold price are up 10% year over year in July. Buyers outnumbering sellers here. Continued price increase, very strong indicator of housing demand, and home sizes are increasing as well. So there are strong aspects. This really paints a picture of the pent-up demand that we're seeing, and it helps to explain the low home sales. I have covered, whether in the newsletter or on the video here, all different angles of saying the same thing. Home prices are high, sales are low, and it's because of the high interest rates. And this confirms it here, puts a little bit more numbers to it, and maybe there's a shred of hope that things will loosen up in the future.
For home buyers, that would be nice. I think what's we can be sure of is that the demand for housing is very strong right now, whether it's for single-family homes or rentals, but people looking for a place to live.
And as a complement to the Atlantic article, it's not just interest rates that are going to free up the housing crisis. Interest rates alone are not going to solve this problem. We have to have a regulatory environment where it's easier to build and increase the housing supply. Otherwise, potentially, all that's going to happen is housing prices go up, catastrophic.
Well, that's what. And getting back to last week's episode, talking about proposals, policy proposals from the Harris administration, Trump administration. There's talk of a $25,000 first-time homebuyer tax credit.
Yeah.
Looking at this data, is it really needed? It sounds like about more than a third of homebuyers are all first-time homebuyers anyway. It begs the question: is buying a home a right as an American? Should we all get assistance, and is that the best way to do it? Or, as I believe you just suggested, Matt, is again, if we give this more supply, the prices will become a little bit more normal, loosen up a little bit, and more folks will be able to afford a home.
It just seems like the logic of it.
They need to raise the prices so the housing market crashes.
Yeah, exactly. So I was colored by the first interpretation of that $25,000 idea. That's colored. That's biased me forever against it, because it's just like they even said, like, okay, they give a $25,000 subsidy to first time home buyers. How in the world does that not just make housing prices $25,000
prices don't
more
go
expensive?
down in that scenario? When more people all of a sudden can buy, there's more buyers in the market who have a $25K check burden on their pocket.
Yeah,
exactly.
And there was there was even explanation on how they would try to make that money so it's a tax credit, but they want to also make it so that it contributes directly to the home price, so they can use that money right away rather than kind of waiting for the taxes to come in. And so this is really
like a mail-in rebate,
a little bit, but so like they could actually use it. I don't know what the language was, but that was basically it. It was they want to make it as applicable as possible to that actual purchase action for the house. And again, it's so close there. There's no way to think
they'll
of it
come up with their, Federal Reserve, cryptocurrency, the Fed coin, and they'll issue just some FRN coins.
Yeah. That's I thought you were going to say maybe like a coupon redeemable only for one house, like house bucks you could only spend on. I don't know.
Yeah, that basic. Yeah. On chain.
I do think again. The policy, if you spent that $25,000 and contributed towards the increase of housing in general, rather than putting it on, giving it to people, it feels mean, but I think that will get you somewhere a lot more productive than to just increase the prices in this way and inject that money into it. Is the fact that it is. So if you're giving $25,000 to everyone, no problem. But the minute you're saying it's only when you're a first time home buyer, then it's like, well, that specific thing, that price is going to go up. There's like no way that it doesn't, right?
Yeah.
I don't know.
Yeah. And again, it's just, to me, that's just too much of the government just like absolutely putting their thumb on the scale of a part of the economy they don't truly understand.
Yeah.
Because it's obviously for political purposes. It's not for like actual, like this is going to fix the problem. This is just like literally, hey, you are voting block that I need. What if I hook you up with $25,000? Would you be interested?
Sweet. Let's see how that goes.
There's a lot of that being thrown around. Okay. Moving on, Matt, to the Joint Center for Housing Studies. We cover the JCHS quite a bit here on the report. And from Peyton Whitney, rental markets are cooling, but rents still far exceed pre-pandemic levels. This was interesting because my first takeaway, Matt, that I when we were looking at this, in Figure 1, it basically says, despite this cooling, talking about how rents have cooled, in the last year and a half, despite the cooling, rents have increased significantly since before the pandemic, landing fully 20.9% above those from 5 years ago. Now, some rough math, Matt. That puts about the annual rate of growth, which it was not smooth like this, as the chart depicts. It's about 4% a year. Average rent growth is like more like 3-ish%. So I'm just thinking. Now, obviously, if you look at the chart, there were some years below 3% nationally. Most markets are kind of around anywhere between 2.5% and 4%. 4% doesn't sound that bad relative to inflation over the last couple of years. The inflation angle, I think, is important to acknowledge. Now, there is... especially compared to single-family homes.
The single-family homes is like the real argument stopper, I feel like. But I like at least that they acknowledge that we have had, rent data that we've seen lower and in sometimes negative rent growth. And I think that rents are far above what they would have been according to historical rent growth trends. Maybe they are about $100 more than they would have been if they continued the pre-pandemic patterns. But
is it because of the pandemic or because of RealPage?
I don't think it's because of RealPage or any kind of rent algorithm. I do think it is because of these these topics. We had bigger fish to fry. Well, these bigger fishes of how that's also bigger than any one.
I only bring it up because it seems like such a big deal to some people, but we can talk, like, if we're actually seriously talking about this, we're going to talk about every other reason. But
No, it's so true. And I think it is worth talking about it. The size of this housing demand and the inputs into it are a lot more complicated, and there's a lot more powerful things going on rather than like a software company that people use for rents. But
if Blackstone can't move the market, RealPage ain't moving the market.
Maybe they're trying.
Maybe trying.
So I like these graphs that show where rent growth has gone, especially in specific regions. And I also like this graph. They have a scatter plot here in Figure 3 where they measure the rent growth of different cities with the recent rent growth on the y-axis and the total rent growth since the pandemic on the x-axis. Took me a couple seconds to figure it out, but then I was like, oh, okay, this is a really interesting graph.
Yeah, I like this.
And they show so the ones that are up high are the ones that have grown recently. The ones that are far to the right are the ones that have grown the most in the past 5 years. So, for example, Tampa, it is low. It is in the past year it has had negative 3% rent growth, but overall it has had 34% rent growth. So that is insanity. West Palm Beach, what is that? For 38% rent growth and a little under, maybe a -1 rent growth in the past year. But what's more interesting to me is the story of regions. You can see specifically those Sunbelt markets in the South are the ones that have had the lowest rent growth in the past year, but the highest rent growth overall. And then going back from that is the markets in the West, which have had slightly better recent rent growth and slightly worse overall rent growth, but still kind of group those with the South. And then the real standout here, I would say, is the Midwest, which is kind of middle of the pack when it comes to overall rent growth, and maybe middle of the pack, maybe almost to the upper side of the pack. And it also has had the highest rent growth in the past year. Right under that is the Northeast, which has had slightly lower overall and slightly lower recent rent growth. But I would say the Northeast ones, there's not as many markets, so I'm not quite so sure as about the representation there. But still, it's really interesting to see the story that we've been telling of Midwest stability represented here on this graph.
Yeah, I mean, you think of some of these. You go to a market like Austin or Jacksonville, for some of the high growth. And again, maybe when we look at this from 2019 through 2029, it'll even itself out a little bit more. And Austin, will have a little bit, stronger growth, closer to the Midwest. But you weren't getting paid any premium. If anything, you were losing out, by thinking that Austin was going to be a higher growth market. I mean, all of these, there's only Minneapolis is the only outlier that has not performed has underperformed Austin and Sunbelt, other southern markets, and Minneapolis has its own dynamics going on that kind of. I mean, it's obviously still in the Midwest, but it had some unique characteristics that led for underperformance. But a lot of the Midwest, kind of in that middle bracket of like overall rent growth, very solid, kind of the middle of the pack in terms of the last couple of years, but over the last year, also very strong.
And it means, it's less risky. If you got caught on the wrong side of a apartment in Austin, Jacksonville, or Tampa, then you could be really in negative territory. And lots of people are. It's just because lots of new apartments came up, and maybe that affected some people and shrunk rents in that area. So it's not a horror or unlikely that has happened, but it's just a credit, I guess, to the more stable markets in the Midwest.
Yeah, good point. Anything else on this piece?
No, not much really. It's just I wanted to show that the Harvard Business Joint Center for Housing Studies, as much as they have talked a lot about housing affordability, and they're really harping on that. And I would say that they are a quiver in rent control's arrow sometimes, but they are at least acknowledging that recent rents have not been.
We're getting ready to look at an article from RealPage, so people don't say that we're just I don't know on this. I guess we are on the side of the landlords in the apartment industry. Yep. I mean, that is what we do. But just trying to show a little bit of balance.
Sure.
So speaking of that, from RealPage, major themes in the second quarter earnings call from Multifamily REITs, the real estate investment trusts that invest into the multifamily industry. They had those. It was a couple weeks ago, but RealPage did a really nice write-up on what some of the takeaways of some of the largest apartment owners in the country. Matt, what were some of the highlights?
So I went into this thinking, all right, they're presenting kind of to their like shareholders, or they're presenting this, and so they want to say that everything's going great. Obviously, they want to put it in the best possible light, but there probably are legal reasons that mean that they have to be fairly accurate in what they're representing. Otherwise, they were going to give people the wrong idea. But so that's what I'm assuming is they're constrained somewhat to accuracy, but they're going to do their best to make themselves look great and amazing. I liked the note on operating costs. It was Nareit said that disciplined balance sheets are enabling REITs to enjoy greater operational flexibility and face less stress than their counterparts with higher debt loads and costs. Doesn't sound like anything.
Well, Nareit's a trade organization that tracks.
Okay.
A lot of private and public real estate investment trusts.
I just saw like a statement like that was interesting because it really so they're more disciplined. I don't know who. I'm guessing counterparts are what, like syndicators and smaller apartment owners, but that when they're talking about managing expenses, I think they get into kind of fuzzier language. So it was just frustrated to get relatively few details here on the things that work best for controlling expense growth. But ideas like sharing staff and resources among nearby apartment properties, that's easier for me to wrap my head around. And that's something that they do talk about. They mention optimizing technology systems, but that doesn't really mean anything to me. Like what kinds of technology? There's a number of different technology. There are hundreds of salesmen that would love to help you optimize, but you're going to be spending more money. I'm sure.
They want to give all the secret sauce.
Right? Secret sauce.
They don't want to give away the tech stack.
Yeah, that's true. But I still think, it's probably this quotidian, mundane stuff of like spending $200 on an AC part rather than replacing the whole unit, or just being sensible and taking care. And that's where I guess I will loop back to discipline as maybe Nareit was right in calling out discipline as really important at this time. But there's probably not a one size fits all technology optimization solution for everyone. You just have to kind of stick to your knitting.
Well, let's go to the bottom of the RealPage. Do they have any? Is there a pitch? No.
Yeah. We can help you. With costs. On the more positive side, demand is better than expected. Avalon Bay says that sectors of the economy that encompass their core customer base are at effectively full employment with stable job and income prospects. Camden Property Trust, Essex Property Trust says similar things when they're talking about demand. They never really talked about specific, like our apartments are seeing more rent, at least in the quotes here. Their statements about demand are about larger demand drivers. So Camden talks about household formation driven by population and employment growth, apartment affordability, and positive demographic trends. Essex Property Trust says improvement in domestic migration patterns on the West Coast. And Essex points out, now this, I still think this is, again, looping back to what we are talking about with single-family homes. It is 2.8 times more expensive to own than to rent in our markets today, compared to 1.7 back in 2019 when interest rates were near their historical low. So I think that even if mortgage rates were to revert back to their 2019 level, home ownership in our markets will remain significantly less affordable than renting. That's the full quote there. And I completely agree with it. Something that we've been saying, and it's something that the REITs are highlighting in their earnings statements. And then finally, about occupancy, Nareit again talks about how high absolute and relative occupancy rates in the face of supply-demand imbalances showcase REITs' prowess in asset selection and management. great. It's just saying things are going well. They're a good cheerleader. Equity Residential posts 96.4% occupancy. Mid-America apartment communities at 95.5% occupancy, up 20 basis points from last quarter. However, I'm guessing they're comparing the slower first quarter to a more kind of peak leasing season in Q2. It just seems like things are at least improving on the short term, and the tone was what I was really focusing on. I think that the managing expenses, the operating cost section would be a lot gloomier and a lot more pessimistic if it was a serious burden. Now they're saying like, yeah, it's still this, we're going to do this, instead of like, man, this is really taking a hit to the bottom line and we have to refigure things.
I think it's a really good point. I think it's less compared to like last year where it was a little bit more of a scramble to get it all figured out because costs are coming up across the board. But now it's like, all right, we things are more expensive, but we've got a little bit of a handle on it.
Optimizing discipline, because I don't think that people would have swallowed that last year when they were really climbing. You can't gloss that over saying, don't worry, we got this thing called discipline. It's like, no, you have to be straight with people. And
last year it was inflationary pressures, pushed up pricing, payroll, contract services, insurance, tax.
Across the board.
It was the whole list. It was like not like I think legitimate excuses, but it was more of a list of like, here, this is why the numbers don't look that great. And then this year it's like, hey, I think we got it under control. Like we still need to work on expenses. That's why like we're not crushing it because frankly like we'll see really good like rent growth like in our portfolio right now. But the net cash flow isn't where we always want it to be.
So do you lie?
Because it's...
Of course not.
Can't lie. The numbers don't lie. Numbers don't lie. And it's on the expense side.
Well, that's what I meant. It's like, is how these people can't lie. We can't lie. Obviously, in our reports, the numbers don't lie. But there are some people, I think, that got themselves in trouble because they were able to kick the can down the road or to not inform their investors of what was actually happening. And so that's kind of what I was getting at. When I was reading this too, I was thinking, well, REITs, they're probably bound by a lot of regulations that say they have to report things. But I don't know what the specific rules are for syndicators. And there are some syndicators I not directly lie, but I mean withhold information until it's a little too late.
Yeah, I don't believe there's any rule that says. I mean, syndications are governed by they're essentially partnerships, so they're governed by. Obviously, there are some rules and regulations, but more specifically related to like selling the securities.
Okay. Yeah.
Or exempt securities. The registered for. But in terms of like reporting, that's whatever's laid out in the operating agreement. And it's a decision.
Yeah.
Someone can go invest in a syndication, and the syndicator can say, "You will receive no reporting. I may send you a distribution. I may not. I mean, if someone agrees to that, why would they? I don't know.
Is it a standard that there's like quarterly reporting or like? I'm wondering what.
It's a good question. The standard, and again, it's not regulated. We can issue. I mean, again, it's regulated by the operating agreement.
Yeah.
So like, right, we're going to give you annual reports, quarterly reports. There's been a trend and a shift in the market for more monthly reporting rather than quarterly. Quarterly, I would say, is the industry standard. Like the quarterly earnings calls that the REITs are doing. Now they do monthly reports as well. But it's not like they are legally bound to do quarterly filings and issue reports. Great Capital, we decided to do monthly. We used to do quarterly reports. We switched that to monthly. We do monthly reports, but then we do much more in-depth, full quarterly reports. So like the monthly reports are a little bit more abridged, but still kind of updates. But we're not bound to do that other than we tell people that's what we're going to do. That's our decision. And because transparency helps us be competitive in the market. Investors appreciate transparency. Everybody knows what's going on. Allows us to raise more money.
That's what I was kind of getting at. Like, let's say the apartment isn't performing well. There's a little bit of a cost of telling your investors the truth or revealing what is happening and sharing that information. There is a short term, they're not going to be happy about that, but there is a long term, I would say, imperative, because every time you do that, it does not make the problem go away.
And it's a fallacy that, just not tell the investors, let's get it figured out. They understand. I mean, investors they are grown-ups.
Mm-hmm.
They understand. Most, at least, understand that there's a risk involved and not everything goes according to plan. They can understand when something doesn't go according to plan. They appreciate being let know. Then they may want to say what we're doing about it, or what are you doing about it? How are we going to get out of this? What do we do to fix it?
Mm-hmm.
But telling something's wrong, something's wrong, isn't what's going to get an investor mad at you. It's not telling.
Yeah.
And it makes it much harder and much more difficult to, withhold or to kind of cloud the message, and then to say, oh yeah, and this problem's been going on for 6 to 9 months and we didn't really tell you about it.
Yeah.
And now it's gotten to be such a bad problem that I have no other choice to tell you about it, because I'm not going to be able to send you any money, or I'm going to have to ask you for more money for a capital call. It's really bad. And then it's just the shock of like, what are you talking about? What have you been doing? Maybe I could have helped you. Maybe not, but maybe I could have helped you.
Yeah.
And like, this would have been good to know versus, all right, hey, we got a little bit of a problem, working on it. It's still a problem, but here's an update. It's still a problem. It's still a problem. Again, and then if it's like, hey, this is a really big problem, we haven't been able to fix it, but at least if along the way, everyone's kind of on the same page. So,
and I've read a bunch of stuff about, letting people know how things are developing, whether it's like the progress bar on your computer or the progress of your investment.
What's happening? People just want to know what's happening.
Yeah, yeah.
And I think it's a credit to like our teams, in our reporting, but I think just how we communicate. We've always had this philosophy, but we end up not having to do a lot of like after we issue a report, or we don't get a ton of investors, and we have hundreds of investors. We don't get a lot of investors who like regularly call us and are like, hey, what's going on with the property? Give me an update.
Yeah.
I think very like little. And even after we issue like a big report, we may get a couple of questions, sometimes less than a couple of questions.
Yeah.
Because it's all kind of in there. And sometimes it surprises me. Sometimes I think that we'll have questions or comments just because sometimes people are looking to ask some questions or trying to learn more about it. But what I'm trying to say is, when you communicate early and often, the job, it's actually way easier.
Yeah. And I'd like to think probably that it surfaces these things to the forefront. Not that you wouldn't know them already, but building that report is kind of a refresher for the team and highlights some of the things that are going on in the property.
100%. Is that it, Matt?
Yeah, I did have another one, but I dropped it because I think that that it covered exactly this intersection between the rental market and the single family market that we have so clearly covered today. Yeah.
Wonderful. Well, thank you for tuning in and watching or listening to this episode of The Gray Report, whether you are listening in your car on the podcast format or if you are watching us on YouTube. Appreciate it. Make sure you've subscribed to the Gray Capital YouTube channel on YouTube, and you can watch these podcasts. You get full access to The Complex, which is the sister program to the Gray Report, talking more about property management and operations, and also the videos that Gray Capital puts out, and you'll be in the know for the next Gray Capital investment opportunity for accredited investors. Matt, one thing we didn't mention today.
Yeah.
We closed on Solana last week.
Yeah. Congratulations again.
I appreciate it. Congratulations to you as well.
Yeah.
It was a team effort. We've mentioned it a handful of times on the show. And just in case someone was listening, they're like, did you guys ever actually close that deal? Well, it did take us a long time.
It was one of our biggest.
It was one of the biggest. Biggest capital raise we've ever done, $27.7 million. And so big deal. A lot of work, a lot of fun. Well, if you want to know what was delayed, we talked about it last week on the episode related to financing and Fannie Mae. We all got it all worked out. It was a complicated deal. I think 7 different tenants in common. So we had 1031s that came in, but a success. So thank you, everyone that's been watching the Gray Report, that supported Gray Capital through the years. The Gray Capital team, all our partners and investors, could obviously not do any of this without your support. So thank you. Again, hop on over to graycapitalllc.com. If you're interested in investing with Gray Capital, you have to be an accredited investor because of the SEC. But if you're an accredited investor, hop on. You can sign up either for the newsletter or fill out a form saying that you're interested in being an investor, and we'll hop on a meeting see what your goals are, how we can work together. Matt, it's a great episode.
Thanks.
Thank you again. All right, catch everybody next week.